Alright guys, thanks for tuning in. Today we're going to go over the top 10 biggest stock myths out there. This will be a two-part series. We're going to go over the first 10 stock myths in this video and look out for part 2 coming pretty soon. So first, the stock myth I'm going to go over is just because a stock is down doesn't mean it'll come back up. They see a stock that they think is cheap because it was worth around 5,000 a shares when they first had their IPO, and now they're trading at, I don't know, $20 a share. And they're like, oh, it's gonna go back up eventually, just because they see, like, you know, every once in a while it like has a little spike where it goes up 10% and then down another 35%. The biggest example I have to refute this is gonna be Blockbuster. You see in the chart that at one point they were trading at $26 a share and they were bouncing up and down, but after a while they actually are trading less than $1 now. As for the second stock myth, we're gonna go over how just because averaging your stocks doesn't also guarantee a win. This kind of goes back with the first one, where people will buy a stock at, let's say, $25 a share, that'll drop down to 15, and now that they've lost a good percentage of their portfolio in this company, they decide to repurchase the stock, so that way their average now comes down to about $20 a share. So if it ever goes back to their original price they purchased it at, it would actually become a profit. Again, I'm going to use Blockbuster as an example, just because if the stock is continuing down, doesn't mean it'll ever go back up. The third myth is the cheap stocks will make you the richest fastest. Just because you can buy a $10 stock and you buy 100 shares of it, so you spend $1,000, doesn't mean it's better than a stock that's $100 a share that you can get at $10. The reason people assume this is because they're like, oh, since it's at $10, it's not that hard for it to go up about $2 more, which is a 20% gain. Typically stocks that do this are a lot more volatile, and when you have a $2 drop, you lose 20% of your shares or 20% of your equity. The next myth I'm going to go over is that all stocks must come down. There is a little bit of truth to this because no stock will remain there forever, and with every myth out there, there's always a teeny tiny bit of truth, but it's not always a guaranteed rule of thumb. Some of them are more wrong than they are right though, however. So for the example that all stocks must come down, the best one I can give is Amazon. I believe, and I'll put their track record above, but they used to be under $2 a share. And imagine getting it at $2 a share and now it's at $2,500 a share. And thinking it topped out at $20, even though you've already made 10 times your money. If it's a good stock, it'll keep growing. Next is people say you only have to buy name brand stocks. By buying only name brand stocks, you're missing out on the new companies that are emerging, and those are the ones that are typically going to make you 10 times your money. Amazon is now an established business, and yes, they keep growing, but they're not going to make as many gains as they did when they first had their IPO. Next is only buy dividend paying stocks because they're guaranteed money. That's not always true, because when you buy stocks that pay out a dividend, it's typically because the company isn't growing that much anymore. Companies that are growing, they don't pay out a dividend because they need all of their money to reinvest back into the company to expand a lot faster. Another one is it's impossible to beat the market. That also isn't true, because you could take a look at Peter Lynch, for example. He would buy stocks when he was a manager at Fidelity, or the hedge fund manager at Fidelity, and he was known to beat the market almost tenfold. A lot of people that say that it's impossible to beat the market is because they haven't beat the market themselves, so they assume that no one else can beat it. Next, we're going to go over how options and futures are the best way to get rich. This isn't necessarily true. A lot of people disagree about options and futures because they are one of the riskiest ways. Yes, they can get you the richest the fastest, but they also have a lot of downside to them. They can make you go broke the fastest as well. Next, at number 9, we're going to talk about how only the rich can trade stocks. This also isn't true. Nowadays, where you can go on Robinhood and you don't need a minimum amount to deposit, and you can even invite friends, and by doing that, they give you shares in companies. Usually they are about $3 to $5 stocks, but after a decent amount of sales with friends, I think the limit on there is about $600 where they cut you off at, and you could use that money to invest without even really using any of your own money. There's other apps like Acorn that'll invest your money for you, and I know there's other apps too that'll invest for you as if they are a hedge fund manager, and they'll allow you to buy fractional shares. And then lastly for this video, how stocks are the equivalent to gambling. This one is a big myth, and the reason people say it is because they say you can't predict the market and you can't beat the market, which entirely is not true at all. And there has never been a time in a 15-year stretch since 1962 where the stock market didn't deliver a profit. Thank you for watching. Remember to like, comment, subscribe for more future content, and turn on the notification bell so that way you know when our next video comes out. Thanks for watching.